I am Nicholas Bornois of Capital Link, and I would like to welcome you to Capital Link's Trending News podcast series. In this podcast series, we have the opportunity to discuss with company management on recent news and announcements they have made. And I am privileged to have today with us Mr. Robert Bugbee, who is the president of NYSE listed Scorpio Tankers. Our discussion is going to follow on the recent Q2 2023 results, but primarily on company strategy and product tanker sector outlook. A quick disclaimer, that a reminder of the disclaimer that these podcasts are for informational and educational purposes only, and they do not constitute investment advice or any advice. As you all know, Scorpio Tankers is one of the largest product tanker companies in the world, with 112 ships with an average age of 7.5 years, a very eco-efficient modern fleet, and they are listed on the New York Stock Exchange. And without any further delay, I will welcome Robert and thank him for being with us. So Robert, let me start by asking, in the second quarter of 2023, Scorpio Tankers had another very strong quarter. Strong results are always the combination of market conditions, but also of corporate strategy. So before we go to the market conditions, can we focus on the cornerstones of your corporate strategy that helped you achieve the results?
Okay, so I think the first thing is that the company has a very large, homogeneous, modern product tanker fleet that's primarily on the spot market, over 91% on the spot market. And in a strong market, that's exactly what we want. We're able to get the premium cargoes from the customers. We're able to triangulate efficiently, operate efficiently, and we have very little downtime time in a strong market.
Any other elements of your corporate strategy? You've been talking about the leveraging. I mean, you have a number of things.
Yeah, but first of all, that's what drives the ability to deleverage and the ability to do all the other goodies is, first of all, creating cash flow. So we have strong cash flow because we have very little CapEx. We have almost zero CapEx. It's just the CapEx required for maintenance of a very modern fleet. We have nothing on order. We're not buying anything, and we've done predominantly all of our dry dockings, or the majority of our dry dockings during the COVID period. So that's sort of enabling the revenue to come in. Now, the next thing is we've spent the last year or so deleveraging the company. The company was quite highly leveraged. We've also spent the period in paying down our more expensive debt as well, and our more expensive leases. And then recently we have put in place quite a large credit facility under commercial banking terms that allows us the flexibility now to really get efficient on the actual balance sheet, not just in terms of interest rates or margin costs, but also in terms of managing the cash flow and managing the liquidity opportunities of the company.
Robert, another good use of your strong cash flow has been the share repurchase program. You have implemented one of the largest share repurchase programs in history, in a way. Since 2022, you have repurchased 12.5 million shares at about 582 million. So is this likely to continue?
I think it's likely to continue to the extent that we have a strong balance sheet, which we do, great liquidity, which we do. We announced a tremendous amount of liquidity, over $680 million, cash on the balance sheet in our recent earnings report. And we have the opportunity, and the opportunity is that the shares are trading substantially below the net asset value of what we believe the company is worth. And that's the case as it stands today. So to the degree that continues, our allocation of capital will be simply between debt repayment and stock repurchase. We have no interest in adding to the fleet. There's no need to. We don't need any new buildings because the fleet's a new fleet. And it's the most efficient form and effective form of capital allocation to buy shares at the moment.
Well, another way to reward shareholders, which we have been doing, of course, is through the quarterly dividend. You have, as you mentioned, a very strong liquidity, 693 million actually in cash and equivalents. Your share price right now is about 49 plus, and it's 25 cents per quarter, which is $1 per year, about 2% annualized. Any plans to increase your quarterly dividend, or any plans to use your cash flow in other directions?
I don't think we'd use our cash flow in other directions. We wouldn't, no point in buying ships, no point in ordering ships, no point in buying companies. But I think when it comes to increasing the dividend, that's going to be the fruit of doing what we're doing now. If you run this out, where we're both deleveraging and shrinking the share float, then that puts us in a fantastic position to increase dividends. And it's very tempting to go for the early gratification of just paying a special dividend right now out of the 680 million, or increasing the dividend, or changing our dividend policy to a percentage of profits or something. But that would be wrong. That would just be, let's say, pleasing the children. And, in the long term, everyone is better off if we reinvest the money at this massive discount that we're given. Rather than, as I speak as a shareholder myself, I much prefer to buy at a steep discount a share in this company that be paid a dividend that I'm going to have to pay tax on.
So let's now turn to the sector. In our last podcast in May, we mentioned in our discussion that the only thing to fear about the sector was fear itself. So looking ahead, does this concept still hold?
More than ever. I mean, look what we've just been through. I mean, you had tremendous fear for no reason whatsoever in the last, but 3-4 weeks ago, the stock of Scorpio Tankers, the other product tanker companies, was much lower. You even have had analysts right at the bottom downgrade. I mean, they've literally, one analyst picked the bottom perfectly. And this was all to do with fear. They looked at the rates that had come down and they got afraid. They got afraid that the cycle wouldn't come back, the really demand wasn't there. And rather than looking at the situation and realizing that, when you have LRs at 27 a day plus, and you have, and you have MRs 29,000 plus in that period where you're most afraid, wow, that's an incredibly high number to have at the bottom. So the fear made people sell them. The reality or the realistic analysis would have been, wow, we're drawing down inventories. Demand is great. It's the weak season. We've got all this in front of us to come. Every single analyst reporting crude oil product demand was looking at a second half increase in demand. And, the opportunity was to realize that the market bottomed at a very high cash flow number. So therefore, looking forward again, I'm sure that there'll be, winter isn't coming for a little while now. Autumn isn't coming for, not so far away, but still a little while. I'm sure that there'll be faint hearts the moment we get the market trading down $2,000 or $3,000 a day. It doesn't matter where it is. But I think that it's important, again, to keep courage up and understand that the world's going to have to move that product. It has to do it. We're not seeing a reduction in use of products. We're seeing an acceleration. And when we get to the winter, if Europe hasn't prepared during the autumn, then you're going to see diesel, heating oils fly into Europe. And the only place they can come from is going to be the Middle East or from China. And that's going to see, a real rapid increase in ton miles.
So, Robert, based on what I hear from you, it seems the stars are all aligned because we have rebounding demand, low order book, So very tight supply-demand balance, and we're coming into the seasonally stronger period. So that means that you can be optimistic that the freights will continue to remain strong or improve further?
Yes, as I said, I expect that to be even stronger than where they are today. Once we get further in, and they're still strengthening, right now, but that doesn't mean they won't sort of go up in a jagged form, or there might be a period of a week or two, depending on where arbitrages are, where you get a little weakness. But that's the period that's the point when one shouldn't be afraid. One should just look up and look at the sort of the macro picture related to the trade flows themselves.
But given exactly the fact that we have a strong market, we expect the market to continue stronger, and at the same time we have a very low order book. Are you concerned that we may have a flurry of new building orders, as it always happens when things are very good?
That's sure. We've had an increase in new building orders in the last months, but we've also, what isn't often looked at is we've had an increase in the delivery date too. So, you have to measure the new building order book over the time period that it's being, booked in. And right now, those yards are getting, they've gone now in 2005. We're well into 2006. So, the book is, these orders are going in for much, much later, at a point where the actual age of the fleet within the product market will be in crisis. So it's very difficult to create a scenario for a number of years where the order book plus the existing supply is going to overwhelm demand minus vessels that get aged.
So one more question to ask you. Sanctions on Russia and the gray fleet, how are they impacting shipping?
Well, we've seen just a difference in ton miles and inefficiency. Whenever you split a fleet or split any form of supply, it creates inefficiency. So, the easiest way to look at it is inefficiency.
So, Robert, this is not a softball question. It's a real question in the sense that here we have all this we discussed: solid corporate strategy, strong balance sheet, strong product market fundamentals, and outlook. So how can anyone explain the fact that, as you mentioned, your share is trading a substantial discount to what you believe your NAV is?
My personal opinion would be, and I can understand it, is that if you look at it, we've seen oil under tremendous pressure but because oil itself has been caught up in the recession trade. So we've seen at times recently that the lowest, long position in a decade in terms of the paper markets in oil. So many funds have been using oil as a proxy for future recession. And at the same time, underneath it, you've had oil tightening up in terms of the physical position. That we've had rhetoric that has sort of said, well, the Arabs have said, oh, we're cutting oil because there's not enough demand. And we've seen figures from various governments in inventories actually revised upwards in these last weeks. So it's quite understandable that fear was there, and fear was real with people. So I'm not going to really, that's how I think it is. There's no point in, it's much better to act and buy stock than actually worry why something is down a lot of the time.
Absolutely.
So
last question to ask you, even though this is not directly related to Scorpio Tankers, the publicly listed entity, still I'm curious about the rationale behind the private side of Scorpio buying into Handymax and Artmore. Why do this rather than invest in Scorpio Tankers that is publicly listed?
That's a very fair question. During this last 2-3 weeks or so, we just haven't had the opportunity to buy into Scorpio Tankers. We've been prohibited from buying into Scorpio Tankers because we were so close to earnings, and our insider policy prohibited us. It would have prohibited us from doing that. And this market inflected at a very rapid point. I mean, 2.5 weeks ago, it just suddenly, it was so tight. That's what I was explaining. The market was tight enough that even in a slack period, it was producing great rates on a historical basis. So as soon as the demand kicked in, as soon as oil started pricing upwards, and we've seen this rapid increase in oil, but we've also seen a larger increase in the price of refined products. So we saw refinery spreads really open up, and so therefore demand was stimulated quickly. And we felt early on, a couple of weeks ago, that this was going to be so, key, and such a incredibly violent change in the narrative that was likely to be talked about by the companies and the actual analysts. And it literally, way before autumn, that we just thought there was a fantastic investment opportunity in Artmore and in Hafnia. Both are very well-run companies. Both were trading, and still are, the same as Sting, at very poor value to price to the actual underlying value in the market opportunity. So rather than just sit on our hands and go, oh, what a shame, we can't buy Sting, we started buying Artmore and Hafnia.
Very interesting.
Normally, in one way or another, all ships rise in the tide.
Absolutely. So, Robert, we've reached the end of our discussion, which as always has been very interesting. Any closing remarks?
No, we really appreciate this. We're super excited because this inflection point was faster, earlier, and far more ferocious than even we would have expected. And we're normally the most bullish there is out there, so that puts an extra big smile on our faces, because we're seeing the change of the season coming, and certain players really have to act. And I would just add that if we have a situation where the United States West Coast has to be fed from China and the Middle East, and Europe has to be fed from the Middle East, maybe Brazil has to be fed from the Middle East because the US itself doesn't have as much export capacity as before, then we are going to see an expansion in rates that have yet been seen in this cycle to the upside.
Robert, thank you very much. Again, as always, it's been extremely interesting to have you with us. Thank you for the time and the insight. This is Nicholas Bornois of Capital Link, and we have the privilege to discuss with Mr. Robert Bugbee, the president of NYSE listed Scorpio Tankers. Thank you, Robert.
Thank you.